Welcome to Orders of Magnitude, the hidden math of the stock market. Look at a stock chart for 10 seconds and your brain does something automatic. It starts drawing lines. A peak here, a dip there, a trend that had to reverse. We are pattern-finding machines, staring at one of the most pattern-resistant things humans have ever built. A price that, minute to minute, behaves almost exactly like a coin, flipped over and over again. And yet, almost is the whole story. Because hiding inside that noise is a strange and beautiful kind of order. Returns that multiply instead of add. Rare crashes far more common than they should be. And a quiet, relentless force that turns a boring 7% a year into a fortune, or wipes it out. The market looks like chaos, but chaos, it turns out, has rules. In this video, we're going to find them. So where does a price even come from? At any instant, a crowd of buyers and sellers, roughly balanced, push it up or down by a hair. The next tick is almost a coin flip, a little up or a little down, and the price has no memory of where it's been. Now flip that coin a million times and stack the results, and you get something eerily familiar, a stock chart. Mathematicians have a name for this, a random walk. Picture someone stumbling home in the dark, each step a coin flip left or right. Watch long enough and their path looks purposeful, full of trends. It isn't. It's just a million tiny accidents added up. Here's the unsettling part. Let a computer flip coins. No company, no news, no economy. And draw the line. It will have everything the experts point to. Support levels, breakouts, a textbook head and shoulders. Now put it next to a real stock. Can you tell which is which? In study after study, professionals can't. Our brains are wired to find a face in every cloud and a reason for every wiggle. Psychologists call it apophenia. And a price chart is the perfect cloud. Most of the patterns people trade on are weather forecasts read from television static. But the market is not only a coin flip. And here's where it breaks from one. Money doesn't add, it multiplies. Lose half your money and you don't need 50% to get back. You need 100. A fall and an equal-looking rise do not cancel out. So straight lines lie to us. To see the market honestly, we have to stop counting in dollars added and start thinking in percentages, in multiplications. That's the real reason analysts quietly switch their charts to a log scale. On it, equal percentage moves finally look equal, and the market's true shape appears. And multiplication, repeated, is the most powerful force in all of finance. A dull 7% a year doesn't add 7. It multiplies your money by 1.07, again and again and again. 10 years in, it has doubled. 30 years in, nearly 8 times over. 40 years, and a single dollar becomes 15. This is compounding, the engine behind every quiet fortune, and the exact reason this channel is called Orders of Magnitude. Wealth doesn't grow in steps, it grows in powers. Start early, and time does almost all the work for you. Want to see compounding inside a single human life? Take Warren Buffett. He bought his first stock at age 11, and by 30, he was already a millionaire. Impressive. But here's the part almost everyone misses. More than 99% of his fortune was built after his 50th birthday. The vast majority of it came after 65, the age most people retire. He didn't suddenly get better at picking stocks. He simply let the money multiply for over 70 years. His skill is investing, but his secret is time. But multiplication cuts both ways, and it hides a trap. Suppose a stock goes up 50%, then down 50%. The average of plus 50 and minus 50 is 0, so you broke even, right? Run the actual money. $100 becomes $150, then drops to 75. You didn't break even. You lost a quarter of everything. The swings themselves cost you. The cheerful average return on the brochure is almost never the number that lands in your pocket, and the gap between them has a name: volatility. Turbulence is a tax, and you pay it in compounding. Now the dangerous part, the assumption that has blown up banks. Finance loves the bell curve. Most days, small, calm moves. Enormous moves, essentially impossible. By that tidy math, the crash of 1987 should strike about once every several billion years. Instead, markets have lived through crashes like it again and again inside a single human lifetime. The real distribution of returns has what statisticians call fat tails. Extreme events are rare, yes, but nowhere remotely as rare as the elegant equation promised. The model wasn't a little wrong. It was wrong about exactly the days that matter most. Why are the wild days so stubbornly common? Because market moves don't follow the bell curve. They follow a power law. And we've met a power law before in episode 1. Benford's law, the strange fingerprint of things that grow by multiplying. Watch what it does to a chart. Zoom in to a single minute, out to a day, out to a decade, and you genuinely cannot tell which is which. The shape repeats at every scale. The market is a fractal. There is no normal size for a move. Big storms breed bigger storms, and that self-similarity is precisely why the calm formulas keep getting ambushed. So can anyone actually win? You cannot predict the next tick. That part is pure noise, and the patterns are static. But you can know the shape, and the shape hands you 3 quiet edges. 1. Time in the market beats timing the market. Let compounding run. 2. Spread your bets across everything, and the fat tails stop being able to ruin you. And 3. The one number you fully control. Remember episode 2, where the casino's tiny edge bled the gambler dry? Fees are that edge, aimed back at you. A 1% yearly fee, compounded across 40 years, quietly devours roughly a third of your final wealth. So flip the table. Be the house. Own the entire market, pay almost nothing, and wait. The market looks like chaos, and minute to minute, it truly is. You will never read the next tick in the noise, but the noise has a shape. It multiplies instead of adds. It compounds into orders of magnitude. It hides fat tails where the textbook swears there are none. And it repeats itself at every scale you look. That is the hidden math of the stock market. Not a crystal ball, but a map. Not a way to beat the chaos, but a way to stop being beaten by it. Chaos with rules. Now you know where to look. Thanks for watching. If this changed how you see the market, do me a favor, like the video and subscribe. There's more hidden math on the way. I'll see you in the next one.